Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Once again, I'm bringing you a subscriber request Tuesday, although this is a little different than I've been normally doing because, as I mentioned in my first video in this series, I had a subscriber, Golden Turd Zenaru, who asked me to cover all the sectors and try to find at least 3 stocks of value in every sector. And I went ahead and did that, and I've come up with more than 3 stocks, so I'm going to go ahead and give you the ones I found. Now, I'm running very simple screens. I'm looking for credit ratings of BBB minus or better. In other words, investment-grade companies. I'm looking for earnings yields of 6% or better. Now, 6.5% to 7% is my preferred minimum, so I'm giving it a little bit of fudge factor on that one. And I'm looking at estimated total returns of at least 5%. I want to see companies that can give me a 5% rate of return. Now, these screens that I've run here for this, covering all the 11 sectors, they're not comprehensive, okay? They're just giving me a good indication of what kind of value we have in this overvalued market. And I think that's real important. I've been stressing that throughout this series. So let's go to FastGraphs here now, and let's look at the S&P 500 once again. We have a market that normally trades between 15 and 18 times earnings. That's the orange line on the graph is 15 times earnings. The blue line on the graph is 18.5 or 18.43 times earnings. And that's just kind of a normal range of value, if you will, indicating that the market is reasonably valued. It's preferably, better at 15 or below when the price is below the orange line. That's a PE ratio below 15. When the price is above the orange line, that would represent a PE ratio above 15. And of course, what we see now is the price has really dramatically risen above that. So we're in what I consider to be a very, very expensive overall stock market. But as I always preached, it's a market of stocks and not a stock market. So what we're doing here is looking at the individual constituents within these 500 stocks in the S&P 500 and trying to see which ones are, breaking the mold, if you will, that are not overvalued like the overall market is. Now, in this particular video, I'm running the consumer staples sector. Again, I went through simple screens. BBB minus, earnings yield 6% or better, estimated total return of 5%, future total return of at least 5%. I've come up with 8 names that I think are very, very interesting here. We're going to go ahead and review those 8 names. Now, I'm doing a kind of a high-level overview here. I'm not going to get into deeply on any one of these companies. If any of them interest you, I leave it to you to go ahead and research them on your own. But it's very, very interesting to see how few companies in the overall sector are actually met those very simple criteria that I created. So let's go ahead and start by looking at the companies. I have to get these ones that I have trouble pronouncing. I don't even know how to pronounce it, but we'll call it Ahold, okay? And then I've got Elementation, Couche, Tard. And then I've got Bungie, British American Tobacco, Japan Tobacco, Kroger, Altria, Walgreens, and Boots Alliance. These are the 8 stocks in the consumer staples. But I also want to make another point with this video. These are all consumer staples as far as the general GIC sector, okay, which again is consumer staples. But the sub-industry sectors, they're all different. I've got food retail, agricultural products, tobacco, and drug retail. Okay, so I've got a diversity of different kind of stocks throughout different subsectors within this overall sector. Let's go ahead and look at them individually, if you will, and I'll go ahead and start in alphabetical order here. I'll start with this I don't know how to pronounce that. Pardon me. If you know how to pronounce it, I'm going to call it Ahold. And there's things I want you to see here about it. Every company I'm going to show you here is different. They're all stocks. They're all in the marketplace, but they're very, very different from each other. Now, number one is, interestingly enough, with this particular company, you saw coming into the recession of 2000, the stock was very, very overpriced. That was true of an awful lot of companies at that time. And you can see the correction. The fact earnings determine market price. You can see where the company's earnings went, the stock price eventually followed. And that becomes very clear since coming out of the Great Recession of 2008, where the stock price really tracked earnings. And when it gets disconnected above or below, it always reverts to that mean. But the other point that I want to make is not this reversion to the mean, but the fact that the stock price tracks earnings. So when you eliminate some of that original data there where it was really disconnected, you can see that since the Great Recession, this stock has tracked the value of its business, the earnings of the business, very, very closely. It does offer a 2.31% dividend yield, has an earnings yield over 7%, and is available at a blended PE of 14.18. That's slightly below its normal PE and slightly below what the market would, or what the growth of this company would suggest is the intrinsic value. It has a bit of a spotty dividend record. It has consistently paid a dividend, but on occasion, as you can see, they have cut their dividend slightly. But nevertheless, they've maintained a pretty good payout ratio all along, somewhere in the 40% range. Occasionally gets a lot lower than that. But anyway, this is an interesting looking company, decent stock, grows about 6.5%. That's about average for the market. That's about what the S&P did. If you look at the S&P 500, it grew at 6.27%, and yet it's massively overvalued. And here we have an example of a stock that grew actually slightly faster than the market and is trading at a much lower PE. So that's the first one. Next one I'm going to look at is Elementation, Couche. Boy, these ones that have these hard names. I've never seen this company before. I found it interesting that, I got a chance to look at a company that I've not watched before. When I look at this company through the lens of fast graphs, I see a couple of things that I find very intriguing. Company's grown at over 22% a year. That's the PE ratio on this orange line is now drawn at a peak equal to the growth rate. That's 22. The stock is normally traded around 16 or 17 times earnings. 16.72 is the PE of the blue line. You can see that generally it's traded at a discount to the orange line, but occasionally, in a few years here, back in fiscal 2015, 16, 17, 18, and so on, it did get up into that 22 multiple. The company has an April fiscal year. It has a dividend yield of 0.89%. It has a very consistent dividend growth record here. They've increased their dividend every year. It has a low dividend payout ratio. This is primarily a growth stock. If I look at long-term performance here, you can see that long-term performance has, really corroborated with the fact of how fast the company's grown. So this is a much faster growing company with a much lower dividend yield. This is the notion that it's a market of stocks, not a stock market. Stocks are quite different. Moving on, I've got Bungie, which is an agricultural products company. It's not a fast grower by any stretch of the imagination, but it actually on average has earnings growth of 8%. And a lot of that comes with just the last couple of years where the growth has really, skyrocketed. You can see very high growth rates here. But, again, you see this relationship between stock price or the value of the business being the orange line and how the stock price relates to the value of the business over time. The stock price tends to go where the business goes. That's a very, very common theme here that I do want you to constantly pick up on. As I show you these companies, we got a 2.18% dividend yield. We got a very consistent dividend record. I think that's important when you're looking at this company. But the earnings record is not so good. And, even buying it at value back here coming into the recession, I want you to note that measuring again at value, you could have lost money. The stock has not been necessarily a stellar performer from a capital appreciation point of view. But that, again, relates to how the business has performed as an operating business. Next company we're going to look at here is British American Tobacco, ADR. You can see very consistent growth, 8.44%. The dividend has risen and fallen, but a lot of that has to do with the fact that this is an ADR. We're looking at foreign currency exchanges and so on. But we got a 7.5% dividend yield, earnings yield of almost 11%, blended PE of 9.1. The stock is extremely undervalued. It has been for the last 2 or 3 years. And this is very interesting to talk about because, again, in contrast to the market, which is trading at a very, very high valuation, even considering that there was some pretty poor performance coming out of COVID. This company's actually had pretty good performance during this time frame, and yet the market is valuing it at a very low valuation. So, you have to look at the individual attributes, individual metrics, and so on of every company you're looking at, not just thinking of it in terms of the generalities like the overall market. I think that's very important to talk about. This stock has its own issues and its own valuation. Of course, it offers a very, very high yield today, but that's what British American Tobacco. This one I really think is important. And I'm really glad it showed up because here you see a company whose earnings have been dropping ever so slightly over the last 5 or 6 years. They are expected to begin rising again. But as a result, I do want you to note that the performance of this company has actually been negative. The capital appreciation, it's actually lost, capital 10,000 turned to 6,200. And again, that's clearly a result of the earnings of the business, getting weaker and weaker as the years pass. Now, currently, the metrics look interesting. It has 4.79% dividend yield, Earnings yield of over 8%, PE ratio of 12.3. Forecasting in the future looks like it's expected to grow at around 4.5%. It's trading at a very low valuation relative to even their historical norms. Longer-term growth is expected to average about 9.5 or 10%. So if that's true, then this company now would be very, very intriguing looking forward. But yet, when you look at it historically, the track record is not that good. But it does give you another sense, if you will, or another perspective of how it's a market of stocks, not a stock market. But once again, you see valuation always coming into play, that when a stock is disconnected from its fair value, it generally reverts to the mean, and that even works when the stock becomes undervalued. So this is Japan Tobacco. It's been, a weak performer here recently. This is another ADR in the consumer staples area. Here's Kroger, your basic grocery store. Very, very clear relationship. You can really see how Kroger has performed as a business. About 7.5% growth, moderate cyclicality, here and there. There are times when earnings flatten. There are times when earnings accelerate and grow. There are times when the price gets, very, very extended above earnings. And there are also many times on this graph when the price got below earnings. But once again, it always returns to its intrinsic value or its fair value as represented by, in this case, a 15 PE. Blended PE currently at 14.04. You can buy it with an earnings yield over 7%, dividend yield about 1.7%. Kroger does have a very excellent dividend record. Their dividend has grown at over 12% a year historically since they've been paying the dividend, and they started paying one in 2007. Again, you can all see this instantly by just, glancing at the fast graph. And then last but not least, we have Altria Group, which I've featured in previous videos. You see how the company's stock price follows its earnings. You see that it gets overvalued here. Was overvalued for 2 or 3 years, by the way. I want you to note that, until the company reverted to the mean. Now, for the last couple of years, 2 or 3 years, the stock's been very undervalued. Once again, like British American Tobacco, there's similarity in the sector, in the subsector, as far as how the market's valuing it. It's trading at a very low valuation of 10.95. In other words, the PE is under 11. It has an earnings yield over 9% and a dividend yield over 7%. So that's, Altria, the old original Philip Morris. That's why the symbol's still MO, you'll notice. They spun off Kraft and Heinz. They spun off Philip Morris International. But this has been a very good long-term investment. You can see the stock price has tracked earnings. Even though it's undervalued today, it's important to point out that it's actually outperformed the market and generated substantially more dividend income than the market, averaging over a 10.6% average rate of return versus 6.9% for the overall market during the same time frame that we're measuring here. So there you have it. You have 8 consumer staples that look very, very attractive that screened out of this market in the very, very expensive and extended S&P 500 right now, or overall stock market, not in the S&P so much, but available in the marketplace. In other words, all stocks are not the same, as I've said. Anyway, this has been Chuck Carnival saying thanks again for watching. Hope you enjoyed this video. If you did, give me a like. Ring the bell if you want to be alerted to new videos coming up. I still got many more to cover in this sector. Even though this was a subscriber request Tuesday, I was originally requested to do this by a subscriber, so I'm going ahead and including it, and probably will for the next Tuesday or so. I still got, I think, 7 or 8 more sectors to cover. But it's very interesting that these 8 companies that are consumer staples, how different they all look, but yet they do all offer some of the characteristics that I screened for. So thanks for watching. By the way, check out our Fast Graph Value Academy. It's a free educational site where we teach finance and how to read financial statements and so on, and teach investing. And it's free of charge. Watch forthcoming videos on that one as well. Anyway, thanks for watching.